Hi, everyone. Welcome to the Weekend Charts, where we cover the most interesting charts and themes in markets and investing. So a lot to cover. Let's jump right in. First topic I want to talk about is bonds, the bond market. If you've been following the bond market of late, you've probably noticed that it's really been moving in one direction only, and that's down. If we look at the U.S. bond market here, we have the Bloomberg U.S. aggregate, and it's down 3% year to date. Which if you're a stock market investor, probably doesn't seem like very much. You can see that in a single day in stocks, but for bonds, this is a pretty bad scenario historically. How do we know that? We take a look back at annual returns for bonds going back to 1977. And the worst year ever actually was in 1994, where stocks declined 2.9%. So as it stands today, if the year ended today, this would actually be the worst year for bonds in history. And so what's driving that? Why are bonds having a harder time this year? Well, in the short run, changes in interest rates dictate everything in the bond market. So as interest rates fall, bond prices rise. And as interest rates rise, bond prices fall. So for 40 years, bond prices were rising as interest rates fell. So in the early 1980s, interest rates peaked. They've continued to fall until their all-time lows in 2020 after the pandemic. And since then, they've been gradually normalizing, gradually rising, and that's put pressure on bonds. And so to kind of put that picture to work here, we're looking at here Treasury yields 1 year through 10 years since the start of 2020. So you see that the crashed lower in 2020 at the start of the pandemic. And since then, we're just kind of normalizing, rising a little bit, the 10-year more so than other durations. But in the past 2 months, you're seeing all durations rise at the same time. And what's driving that? Really two factors. One, you have the Federal Reserve slowing the rate of asset purchases. So they announced last year they were going to start winding down quantitative easing. They're buying less bonds every month, so there's less demand for bonds. And that's expected to end in March this year. A second, more important factor, though, is the Fed is now finally expected to hike interest rates off of 0%. So at the March meeting, there's now 100% probability priced in the bond market that the Fed will indeed hike rates 25 basis points. So why are bonds moving further than that expectation? Because investors are expecting not just one hike, but multiple hikes this year. So if we look at something like Fed funds futures, we can get an idea of the probability that of bond market participants, what they're pricing in terms of expectations. So right now, as it stands today, there's a 65% probability that the Fed will hike at least 5 times in 2022. So that's a significant increase over the past month that we've seen in terms of rate hike expectations. And a lot of people are skeptical that the Fed will indeed hike that many times. I did a poll this week on Twitter asking how many times will the Fed hike. A lot of responses were, why isn't there an option for 0 and things like that, but which I think is highly unlikely given the last FOMC meeting. The Fed made it pretty clear they're going to move in March. So most people think that the Fed won't hike 4 times this year, at least according to this Twitter poll, but the market is disagreeing with that. The market is actually saying that the Fed is going to hike at least 4 or 5 times this year. So we'll keep an eye on this. Of course, it's, as the Fed likes to say, data dependent. Much of this will depend on the trajectory of interest rates and unemployment and other factors. Also depends likely on the effect that it's having on the stock market, which we know the Fed pays close attention to. So all those factors are going to dictate, will the Fed hike less than 4 times, more than 4 times, or exactly 4 times? It's all going to remain to be seen. But unless I think there's a collapse in the markets or the economy, they seem ready to move at long last in March at the March meeting. So that's the first topic. Next thing I want to talk about is social media. So we had a lot of interesting action in social media stocks over the last 2 years. So this is a chart showing the social media ETF, SOCL, versus the S&P 500 ETF going back to the inception of the social media ETF in 2011. And what you see here is On the bottom of the chart is there's swings. There's times when social media is outperforming, other times where it's underperforming. And during the initial stages of the pandemic, of the COVID crash, both went down together. But after that, that's where performance really started to diverge. First, on the upside, where investors became extremely excited about social media stocks, and you saw this huge outperformance of social media as this growth stay-at-home play. So people were signing up to Instagram, Snapchat, Facebook, and all these other apps at faster rates. And the expectation was that would continue for some time. And investors repriced this whole segment of the market along with other high growth stocks. So if we look a year ago, last February, this social media ETF was outperforming the S&P 500 by about 150% since its inception. And just 1 year later, now it's underperforming the S&P by over 100% since its inception. So this is a huge swing in sentiment. We went from people being euphoric about social media companies back to more of a baseline level, and you could even suggest that some are pretty despondent. And really, what's changed here is growth rates, right? So investors are reacting to what they're seeing at the company level, and this has been going on for months. But in this particular quarter that these companies are reporting, we're seeing just more evidence of this. So Facebook, the leading US social media company, is reporting now 20% year-over-year growth in terms of revenues. Well, that's a slowdown. That's from what we saw last year. And importantly, their active users that they report is now only up 4% year-over-year, which is the slowest rate in the company's history. So investors are reacting to that by pricing in future slower growth for Facebook. And it's actually now trading at a discount to the S&P in terms of its price to earnings multiple, which is pretty interesting. So Facebook now trades at a multiple of around 17 times earnings versus 22 to 23 times for the S&P as a whole. Now, what's really driven this sentiment shift from the pandemic lows to February 2021 and now to today is a change in the way investors value these companies. So this chart here, I took an average of the social media companies in that social media ETF and said, what was the average price to sales ratio at any given point in time? And as you can see, they went from trading at less than 5 times sales on average at the March 2020 lows, all the way up to over 14 times, and now back down to 6 times. So the fundamentals of these companies didn't change that much during this period of time to warrant that huge shift in multiple valuation. What changed is investors' expectations. Investor sentiment got really, really excited a year ago, and now is back to more of a normal state. So the question people will be asking in the coming months is 6 times sales reasonable? Is it too high? Is it too low? The overall market, the S&P trades at around 3 times sales, so it's still trading at a premium. So we'll have to see what happens. But the broader picture here is that changes in investor sentiment really drive changes in stock prices in the short run, much more than changes in fundamentals. And when investors get extremely exuberant about the future, you have to be careful, because that might be, they might be pricing in too much. They might be saying their expectations for future growth are too high, and it becomes harder to meet that when you're trading at a price to sales ratio of 14 times. And the next topic, 30 trillion. So we're here. We knew we were going to come here, and people probably didn't think we were going to get to a 30 trillion in national debt this fast. But it's really just following the trajectory that we've seen since the start of the pandemic. So over the last 2 years, we borrowed about $7 trillion in the US. So over 30% increase in the US national debt in just 2 years, which is the fastest rate of increase that we've seen. And what this has done is it's kind of changed the way we look at things like debt to GDP. So debt to GDP started at 31% in 1980. Now we're all the way up to 125%. And much of that increase has happened in the last 15 years. So the way investors thought about that entering 2021 was don't worry about it. Let's borrow more money. Let's spend more money. Let's worry about the impact of this later. And what's interesting is by the end of 2021, the American psyche really changed, and you had people starting to be concerned about inflation and other factors. So perhaps we'll start to see a slowdown next year, and we'll talk about that in a little bit. But over the last 15 years, what's really driving this increase in national debt as a percentage of GDP is simple. It's simple math. We're borrowing way more than the national growth is increasing. So 8.6% per year increase in the national debt on a percentage basis versus a 3.6% increase in nominal GDP. So that's going to lead to an increase in the ratio of debt to GDP. And the question really is will this continue at this pace? And that seems unlikely. The pace of the last 2 years was extremely high. We had those three enormous stimulus bills, and we saw the $2 trillion additional bill rejected at the end of last year. So while we might see some type of increase in spending this year, it remains to be seen. It's not likely to be as big. So if we're looking at a chart of the deficit in the U.S., we have 4 trillion roughly at the peak year over year in terms of the deficit. Now we're down to around 2.5 trillion. And the expectation is that this will end the year at less than 2 trillion in terms of deficit. So still a pretty large deficit by any historical measure, but certainly not at the pace we saw the last 2 years. So a big change, a big shift in the way we think about the debt. There's certainly more concern about inflation, and I think that's driving more of a push to say that the deficit and the debt do matter to some extent, and maybe we have to be careful about increasing it more at this point. But it's still going to go up, right? With even with a $2 trillion deficit, we're going to see more milestones this year. It's just that the rate of growth is likely to slow. Number 4, let's talk about jobs. We had a big report on Friday, and what it showed is that the jobs number, which is pretty volatile from month to month, but it really is a continuing trend that we've seen since May 2020, which is the greatest jobs comeback in U.S. history. We lost 22 million jobs in March and April 2020. Since then, we've gained back 19 million. So it's an incredible comeback in jobs, and I don't think it's done yet. I think by the end of the year, assuming everything goes as expected, we should hit a new high in jobs, which I don't think anyone would have thought was possible back in the early stages of the pandemic in 2020. And what's driving my optimism is that there's a huge available job openings out there in the U.S. There's about 11 million job openings, and if you take that number and subtract the number of unemployed people, we have the largest spread we've ever had. So you have 4.6 million more job openings than there are unemployed people in America. We've never seen a number even close to that. So there's a huge supply demand imbalance, and what this is causing, other than the good side, obviously, is that whoever is still unemployed will likely find a job in the coming months. But another factor that this labor shortage is causing is higher labor prices, right? And so what we saw in Friday's report is a 5.7% increase in hourly earnings, which is continuing a trend of above average earnings growth. So this is adding to the inflationary picture as companies have their biggest input cost is labor. So as that price of labor goes up, what you see is companies respond by increasing prices. And then employees say, well, prices are going up, we need an increase in wages, and so on and so forth. So that's what's known as the inflationary spiral. And so that's expected to continue as long as this supply-demand imbalance continues. On the bottom chart, I think the bottom part of the chart is very important to watch. And it's really the reason why the American psyche changed last year. And thinking in early 2021, the thinking was, don't worry about debt, deficit, inflation. And at the end of 2021, that really changed for a lot of people. And that change is due to the fact that their earnings now are not keeping up with the rate of inflation. So we have 5.7% increase in earnings, 7% inflation. So you're below your purchasing power is going down as long as that continues. So we don't want to see that. You want to see inflation come back below the rate of increase of wages, and that people will feel like they have an increase in prosperity. So that's a better situation. And that's one of the reasons why the Fed needs to start normalizing is to get inflation under control, because you don't want to have the situation where you have in hyperinflation countries where wages can't keep pace with that increasing inflation. So earnings, very important. We're seeing a very interesting sentiment shift in terms of earnings, particularly in big tech throughout this past few weeks. So it's gone from Netflix and the world's coming to an end. And then we had Apple and Google report good numbers, better than expected. And everyone's saying, well, okay, they saved the world. And then Facebook came out and really disappointed. Again, world's coming to an end. And then we ended last week with Amazon and pretty good numbers and saying, everything's going to be just fine. And I think in terms of earnings so far, I think the reactions are much bigger than people were thinking, especially with these big tech companies. So just much more volatility. And we're seeing a higher bar in terms of companies. If you don't surpass expectations, the stock's price seems to be getting hit harder than it has been. So to kind of continue that trend of multiple compression of high growth companies, once the growth starts disappointing, you reprice. So we've seen that a number of times. But overall, nothing really terrible you can see in the Q4 earnings reports. You have S&P sales up 12% year over year. You got revenues, even at companies like Netflix and Facebook that sold that off after earnings, still growing 16, 20%. Google, huge number, 32% revenue growth. Tesla, of course, continues to grow at a rapid pace. And interestingly, ExxonMobil revenue growth tops everybody. So the increase in crude oil has really benefited them. And so we'll talk about that divergence in a little bit. But overall, nothing hugely out of expectations if we look at S&P 500 earnings as a whole. And with that, we're looking here now at charts of S&P 500 earnings on the left side. And we're on pace. We got 67% of companies reported. We're on pace to hit another record high in earnings in Q4, which is above the expectations, actually, that people thought there was going to be a little bit of a dip in earnings in Q4, but it looks like we're going to get another all-time high. And on the right side, in terms of sales growth, still way above average. So 12% sales growth for the S&P is way above the historical average. Obviously, we're still comparing to some of the pandemic numbers, so comps have been easier. And this will be the last quarter where we see that. So, in Q1 of this year, when earnings come out, they're going to be compared to Q1 of last year, and those are going to be much harder comps. So, seeing 60% earnings growth in 2021 was a record year for earnings. We're not going to see that this year. In the next quarter, we're going to see that slow to probably double digits. And then by year end, back to a more normal single digit number. So the outlook has changed in terms of earnings. We're now having tougher comps, and people are really worried about that growth rate slowing more than expectations. Number 6, let's talk a little bit about the fear and the risk of stagflation in the US. And during the correction in January, we saw a very interesting thing that we haven't really seen before in a long time. So the S&P was down over 10% in that January correction. Usually when that happens, you see things like crude oil and energy stocks going down, if not the same as the market, more than the market, because usually there's a fear associated with that downturn in terms of the economy. And if the economy is weakening, you tend to see a weakening in demand for crude oil, and those things go down as well. But we didn't see that during the correction in January, which was pretty fascinating. We saw energy stocks hold up very well. We saw crude oil continue to hit new highs. So a very interesting divergence there. And as it stands now, you have crude oil above $90 a barrel for the first time since 2014. up over 20% on the year. Energy sector is the leading sector by far, up over 20%. And on the flip side, you have S&P 500 down 5% and NASDAQ 100, which is tech heavy, down close to 10%. So this is really a shift in terms of the secular trend that we saw pre-COVID and then during the initial stages of COVID, where you had the tech sector outperforming everything else. You had commodities and energy stocks extremely weak, obviously culminating in crude oil going negative in 2020. But since then, we're starting to see a broad shift. And you can see that more readily in this chart, which is a chart showing the commodity ETF to the S&P 500. As you can see, in the past year, we're kind of trending higher. We're going back to pre-pandemic levels in terms of the ratio of commodities to stocks. So we really haven't seen this in a number of years where stocks are underperforming commodities over a one-year period. So the big question on the macro picture, is this going to be similar to the 1970s, where you have a more stagflationary environment, we have above average inflation, below average growth? And if that's the case, then investors might be betting that commodities will have another period where they outperform stocks. Last thing I want to talk about, some really good news on the COVID front in terms of reopening. So we have just a plummeting rates of COVID in the US from their peak a few weeks ago. This is a chart of cases in the US down over 60% in just a few short weeks. And we're seeing really those declines everywhere. These are the four largest US states: California, Texas, Florida, New York. You see the same thing. Cases are going down rapidly. So if this follows the path of what we saw last year, we should see a big reopening of the economy. There's a lot of pent-up demand. People want to go out, they want to travel, they want to do things again. And I think we'll see that again in the coming months as we head into spring. And so one chart that I like to follow that will track that is airline travel in the US. And this is showing current rates of travel versus the same period in 2019, so pre-COVID levels. And as you can see, we really crashed in March 2020. And then since then, we've just been slowly going back to normal. And it looked like we were going to approach there in July last year. We were going to head maybe back to where we were pre-COVID. Then we were hit with the Delta variant, and so travel came down from there into the period in September where Delta finally peaked. And then, of course, we had the Omicron wave and a second downturn. But now that Omicron's peaked, a lot of people have already gotten COVID. Most of Americans now are vaccinated. Both of those factors, natural immunity, vaccine immunity, is leading to lower fatality rates. So people are feeling, in general, more comfortable in doing things again. So you're likely to see this chart start to move back again to pre-COVID levels, I think, heading into spring. That's good news for everyone. Certainly good news for the travel and leisure industry that really was hit hard and needs to see more of a recovery. So great way to end the week. And have a great weekend, everyone. Thanks for joining us, and we'll see you next week.